Today we're very excited to pitch a short on Match with a target price of $22, representing a 31% IRR, and to share why it's also in my PA. Match is the largest pure-play dating app portfolio company, operating large brands such as Tinder or Hinge. Namely, Tinder constitutes around 85% of EBIT, and Hinge constitutes around 12%. They operate a freemium model, meaning that you can new CEO Spencer Rascoff, or is it the next Match.com? And our bet hinges on the fact that Tinder will be impossible to turn around, and Hinge white space is limited.
So moving on to TAM and market dynamics, just for context, on the left-hand side, we see Tinder paid users, and there's obviously more room to decel to pre-COVID levels. And on the right-hand side, we see quarter-over-quarter incremental payers for Hinge. It's been pretty stable over the past couple of quarters, so we see limited growth potential for Hinge in the future. On the bottom-hand side, we see market share breakdown over the past 5 years. Tinder has lost 9% of market share, while Hinge has gained 6%. And then other competitors in the space have remained pretty stable in terms of market share. And then zooming in on competitive landscape, we broke it down based off of demographics. So for Gen Zs, we see like two market shifts going on right now. So first off, Gen Zers are not as willing to pay for dating apps. 41% of online daters who are 30 years or above have paid for a dating service before, while half that percentage, 30 years or under, have paid before. And then second off, Gen Zs are just not as interested in dating or being on the apps. For millennials specifically, we see COVID pull forward demand, so people are looking for in-person connections, meaning through city running apps, Strava, et cetera, outdoor socials and dinner events. So we see like industry headwinds there as well. So those were like for context, and then now moving into our investment theses, we strictly believe like this is completely underestimated by sell side, but number one, we believe that Tinder reverse flywheel will drive step function MAU churn because of gender asymmetries, and this is not mentioned in any sell side report. And then second of all, Tinder-Hinge cannibalization is completely underappreciated by Street right now, and because of this, we believe in a 1-year price target of $22, an IRR of 31%, and a risk-reward or reward-risk skew of 2.4 to 1. And then for these reasons, we believe in a 1.5x D rating on reduced growth expectations for this 2026 expected EBITDA multiple.
Now, our first thesis is that Tinder value prop deterioration will lead to MAU churn. The first dynamic that's really important to understand here is that for any dating app, gender ratio is of utmost importance. This is mentioned on many TGIS calls, and it's well understood dynamic. And to put it in other words, it means that Tinder's network effects are capped by the number of female users on the app. Now, what initially attracted us to Match as a short as part of Tinder's target audience ourselves is we felt that many female users had churned in 2024, and channel checks sort of backed up our intuition. And we believe there's two structural reasons why this is the case. The first is that they're churning to longer term or safer apps. And the second is that female users are churning along with general MAU churn as culture shifts and Tinder value prop continues to deteriorate. Why this is so important is that female users are churning, the value prop for male payers deteriorates, male payers churn, which in turn causes more females to churn, and the reverse flywheel continues. Now we know that Street has missed this story. For one, they don't break out the gender ratio, and they instead underwrite general MAU re-accel, which occurred in Q4 24, into eventual rebound by 2026. And the second reason, and quite tellingly, management obfuscates key KPIs for the gender ratio. They mention that Hinge has 44% of users being female, but for Tinder, they report that daily number of females has excelled from Q1 to Q3 24. Not only is this metric the wrong metric to use, but it's fully explained by seasonal variance, which occurs in Q3 every single year. On our side, we believe the numbers back our story. Using a combination of Investor Day and earnings reports, we triangulated that the gender ratio is actually 89 to 11. This to us is quite obscene, and it's not mentioned in sell-side notes. And worse, it implies a 26% year-over-year churn in Tinder's female users. And so while Street sees this MAU re-acceleration story as an indication for the future, we see Tinder's core long-term indicator and leading indicator of success and value proposition deteriorating so rapidly over time. And so Tinder's value prop for male pairs is largely tied to the percent of eligible users in their region. And in our illustrative build, we demonstrate that this has decreased in just 1 year about 38%. Where we get differentiation in the short term is that payer delta structurally lags our 2024 value prop differentiation by about 1 year. And we can underwrite MAU churn more quickly in areas of low density. And in the long term, our understanding that this is a long-term dynamic, not one that's just completely reversible by 2026, but instead of reverse flywheel, drives our differentiation in 2027 and beyond. Our second thesis is that Tinder-Hinge cannibalization is misunderstood, and this is to say that we believe Hinge growth is being buoyed by Tinder churn and relies on Tinder churn as white space is limited. Our intuition for white space being limited is one, management sort of boasts that Tinder has this 90% global brand awareness number. We believe this is indicative of limited new to portfolio customers, and at the same time, it's becoming incrementally harder to gain that new user. And we have a SAM build which also demonstrates a low number of people in sufficiently dense areas. We also see evidence of cannibalization. Most notable is that across the industry, market share has stayed roughly stable, but Tinder and Hinge have lost and gained market share in about 1-to-1. And in all data, we see that Hinge download acceleration seems to correlate with Tinder download deceleration. And so while management likes to report this number that 39% of Hinge users also use Tinder, and we think this is quite impressive, the true number we should be calculating, we believe, is payer cannibalization, since many users are not willing to pay for both Tinder and Hinge. And so in our builds, we calculate that 30% of incremental Hinge payers churn from Tinder and were former Tinder payers. Now, we'd be happy to go more into the cannibalization build in Q&A, as it is quite complex, but the bottom line is 15% of aggregate Hinge payers who were formerly from Tinder converges to this 30% incremental over time. And so to us, reverse DCF implies a 0.3% Tinder payer CAGR and a 9.3% Hinge payer CAGR over 10 years. We believe this is completely incompatible with our belief that Hinge's long-term growth algo relies on Tinder churn. And so if we look at this in two scenarios, the first one is, let's suppose Street is right, that Tinder does have that 0.3% payer CAGR. Then we believe that Hinge's true growth rate of around 10 to 14% is revealed, as opposed to the 14 to 18% Street underwrites and Match re-rates on this massive deceleration. And let's suppose that Hinge does hit growth. Well, we believe this is being buoyed by Tinder growth, and Match still re-rates because its largest segment is churning so rapidly.
So moving on to how these investment theses tie into our model. So we decided to focus mainly on Tinder and Hinge. So for Tinder's revenue build, we projected out number of Tinder payers, RPP, as well as direct revenue. And the way that we broke down Tinder payers was to make a side build of the Tinder woman SAM build. So we took a look at the gender asymmetries across population densities by county level, and then projected out the number of eligible women for each county. And we can go into this a little bit more in our appendix during Q&A. But for this build, it revealed very limited expansion opportunities because of the value prop of woman is practically deteriorating, as Tyler mentioned before. And then so this creates a reverse flywheel effect and a 400K delta of paid users compared to Street by fiscal year of 2026. RPP will similarly follow into suit as less people are willing to pay for a platform with less users. So we modeled in a $1 delta in RPP by 2026 as well. For ALC revenue, or a la carte options, we stayed relatively constant to historicals and a historical 80 to 20% subscription to ALC split. And then for our direct revenue, this contributed to a 7% delta of top line growth for Tinder. For Hinge, we took a little bit of a different stance on how to project it out. So we looked at MAUs and specifically payer penetration in terms of MAUs to payers. And the way that we did that is to look at the market penetration in our Hinge SAM build, which we can also delve a little bit more deeply in our appendix. But this revealed very limited greenfield expansion opportunities. And even adding back the 5% triangulation that we did for cannibalization, so Tinder payers moving onto the Hinge platform, that does not offset, or it does not even come close to what sell-side's aggressive modeling entails. And this delta is around 100K paid Hinge subscribers, or Hinge payers, and this reveals a 6% delta in Hinge's top-line growth. And then this is also assuming RPP grows at roughly GDP. So now moving on to our financial summary, we'd just like to reiterate that we expect Match shares to re-rate down 1.5x on the 2026 EBITDA multiple, and this contributes to a price target of $22. Moving on to our risks and mitigants. So recently, or over the past year, Starboard and Elliott are involved in Match, and they might pressure take private concerns if fundamentals of the company continue to deteriorate. However, Spencer Raskoff was recently appointed as a new CEO, and there was also an internal CFO change as well. So with new management, we are a little bit less, or they will be less likely to resist take private concerns for now. And then regarding our event path, or why we believe the share price will change in the next year, is for two main reasons. First off, Tinder churn will be a lot worse than Street expects, and these numbers will come into light in the next two earnings calls, and will cause growth to re-rate 1x. And then next, the post-COVID pull forward demand will continue to persist, and there will be incredible industry headwinds. So with consumer preferences of just meeting in person in general will cause payer user to decline. And then just very briefly going over bear and bull case assumptions. So our key highlights for our bear case is that Tinder will continue to bleed net payers and MAUs. And this is especially important considering Tinder contributes around 85% of its EBIT right now. And even though we account for the cannibalization, it will fail to offset the losses to the majority of the business or Tinder. And this will contribute to 3x multiple derating and a 42% downside within 1 year. For our bull case, this is like what Street expects basically, but for Tinder to revitalize second half of 2026, and this will stabilize RPP and top line. However, we obviously disagree that this will likely to happen because of the reverse flywheel effects in our investment thesis before. But if this were to occur and Hinge grows at pandemic-like growth rates, it will contribute to a 1x multiple re-rating. And then for these reasons, we believe Match Group is a short with a price target of $22 and an IRR of 31%. Thank you so much, and we're open to questions.
The 1.5 assumption on EBITDA multiple decline seems quite precise. Can you talk through kind of how you thought about that and what would catalyze that downward re-rating in the multiple?
I think it really just contributes to the number of pairs that we projected out for both our revenue builds, and that goes down basically to our EBITDA line. But if we look at like our SAM builds or our like illustrative builds that we did, it really shows like a huge delta in Tinder pairs. So wait, let me go see. Yeah, so the way that we did it is we took a lot of data from like TGIS reports and investor day presentations and really like triangulated the process of number of eligible women. If we think about logistically, like per county wise, like the more denser population densities for counties are more likely for people to pay for a service such as Tinder or Hinge, because like you get that network effects of having multiple people on the service, and then obviously more people like willing to pay. So using that process, we were able to find like the best possible case scenario of how many women were on the account or on Hinge basically and Tinder, and then from that we extrapolated that there's only so many like women that we can get to maintain or like persist the top line growth that we have right now. And honestly, like I think like in general we were pretty bullish in terms of, or we were pretty like in our model build pretty conservative with the growth expectations. And I don't know if Tyler wants to add anything, but
I guess what we mean to say by mentioning that fast Tinder payer decel and whatnot is we're seeing this large segment, we get large differentiation on that, and so 1.5 re-rate doesn't seem so bad considering that Street wants this to rebound. So they need this to rebound effectively, and that's what they're underwriting into 2026. We don't see that happening. It's a large proportion of revenues. Bumble re-rated recently about 0.5 sales. I use sales because they're not profitable yet, but that's an even more drastic re-rating on a similar beat that we're underwriting, and so we think it's a fair multiple re-rating.
Yeah.
I saw somewhere you mentioned 3.8 debt to EBITDA. How does that compare to some of their peers, and did any of your thesis rely on hitting any kind of debt covenants and a debt spiral from there?
Yeah, I think right now debt is not like a major concern for the company, just because a lot of their acquisitions were done in the past, and they're actually like, I think their debt schedule is looking decent right now. We actually even built an LBO just in case of like take private concerns, and even in that scenario, we have I think like, let me just flip to it. Yeah, we had a decent IRR. Like this is basically the debt schedule right now. So I don't think like it poses a major risk, but we just added it to the slide because some people were like, this is a little bit higher than some of its competitors, as we can see for the net debt to 2023 EBITDA ratios for their competitors here.
Are you able to elaborate more on the 11% of versus 45 at Hinge? Like what gives you confidence that 11's right and what's talking about it? It just seems so stark. It's hard to believe.
It was hard for us to believe too. They directly report the 44% number. In terms of triangulating the 11% number, they report the number of daily matches per woman, and they also report the number of matches that Tinder generated overall. And so assuming that a male matches to a female in general, that's about 80% of matches, you back out that means that the 11% are women.
Okay.
Yeah. And this is in contrast to a couple years ago, we were looking at all data resources, and the gender split was around 75 to 25%, male to female. So it's exponentially grew over the past couple of quarters as well. And
Basically,
this is like,
it's like number of total daily matches divided by the reported number of daily matches per woman gives you the number of women. And then you match that against the DAU figure, and you find that that's 11% of total DAUs.
Got it.
So can you remind me what portion of the revenue is from Tinder versus maybe some of their foreign brands?
It's around 60% Tinder and around 20% Hinge. The reason why Tinder is such a large proportion of EBIT is because of operational leverage.
yeah.
And so Nedic and things like that.
Sorry.
So they're European plays.
Yeah, it's a very small percentage right now because I think if we look at the business breakdown, we took a look at the EBIT numbers just because top line revenue, like honestly, like MG Asia really contributes like a -% of EBIT right now. And also E&E, which is their evergreen and emerging brands, also contributes like very, very minuscule % of their EBIT. So we mainly took a look at the Tinder-Hinge story right now.
What could the new CEO, Spencer Raskoff, do to hurt the shorts? I mean, one thing that comes to mind is, are there any of the smaller brands that he could acquire to try and reaccelerate the growth story? Like, what's the next Hinge that Match could acquire to spin a growth story to the street?
I guess for one, if they were to do that, given that we're sort of seeing value prop convergence across all dating apps, that would cannibalize from Hinge itself. And so you might see Hinge growth story somewhat being ruined by that. In terms of the core story.
Presumably it's already happening if that's an ongoing competitor. And so if he acquires a fast-growing competitor, that should impact the cannibalization, but that could impact the portfolio growth in a positive way, right?
Yes, but it seems like Hinge really is like
It is like the
main
fast
player right
growing
now, the
platform
fast
right
growing.
now. And I think
in terms of Tinder, we don't think that it's something that's so easily solvable, given the fact that brand reputation has changed so much, and given the fact that we already see value prop deterioration in 2024 that Street doesn't see, that structurally flows into our 2025 differentiation. And so it's not like we're saying anything. It's not like we're saying like Spencer Raskoff is doing something in 2026, 2027, and that's blowing up our short because that's outside our time horizon. But within our 2025 delta that we see from 2024 value prop differentiation, that harm has already been done. We're just waiting for those pairs to churn at this point.
yeah.
Sorry, that's all the questions.
Thank you.
Thank you.